Hello everyone, it's Tuesday, March 14th. Today on the Final Bar, we will talk about this market having a decent rally into the close. The S&P finishing the day up 1.7%. Ladies and gentlemen, this is the Final Bar. Hello everyone, Dave Keller here at StockCharts.com. Thank you so much for joining us for this edition of the Final Bar here from our brand new studio in a very nice and beautiful Redmond, Washington. Appreciate you joining us every weekday after the close as we break down the activity in the markets using the language of technical analysis. I was doing an interview earlier today and was asked about why technical analysis is so important in uncertain times. My comment is, and my comment on that idea was, it's all about understanding investor psychology. When people are excited, when they're nervous, when they're euphoric, when they're desperate, all of those emotions arguably are reflected in price action. So by studying price action, we get a sense of where the crowd is headed. We get a sense of when people, investors are voting with their capital and when buy and sell decisions are manifested in price movements. We have a lot of great charts to review with you in the course of the show today. And let's get right to our market recap. As I mentioned, nice move for the S&P and the major averages into the close. The S&P finishing around 3920. That's up 1.7% from yesterday. Before we get into any of the details, though, I do want to answer a poll we asked you recently, and it's because we have strength right now that I wanted to ask you if you were familiar with the seasonality in the markets. We ask you, what does seasonality tell us is the weakest 6-month period of the year for stocks? I gave you 4 different choices. 85% of you, very well done, Final Bar Nation, correctly answering May through October. If you've heard the market maxim, sell in May and go away, that comes from this particular concept, which is a truism in the markets. If you look over time, May through October has far underperformed the other 6 months, November through April. What's interesting right now is because it is and think about the 4-year presidential cycle, we're in year 3 right now. We're in the pre-election year. And actually, the first half of this year, the pre-election year, actually tends to be pretty strong. So we're now going to enter into this weird sort of juxtaposition where the 4-year cycle tells you it's probably going to be pretty strong. May, June actually tend to start the weaker part of the year. At the end of the day, what's right? I would focus on the action of the prices and actually see what the indexes are telling us about the current environment. With that as the backdrop, let's look again at what happened today. I mentioned the S&P up, the NASDAQ composite up as well, up 2.1% to 11,430, just below that. The only thing showing red on our list of market indexes on the front page is the VIX, moving back down almost 3 full points. That's just below 24. Now remember, I would consider elevated volatility if the VIX is above 20. So even with the pullback that we had here in the VIX, still fairly elevated. And if you ask anyone who's participated in the markets in the last week, I would say elevated volatility is probably a fair adjective to describe what we're seeing right now. Looking at interest rates, you have a push higher overall, kind of a choppiness and big move lower in bonds happened sort of right out of the open. The TLT, which is a measure of bond prices, down about 1.6%. 10-year yields up 1.25% to 364. And if you think about it, sorry, not that much. It's 0.12%, that is, to 364. So you're seeing interest rates move higher a little bit. The movement in bonds, along with all the other asset classes, has been certainly an area of focus. And be prepared for plenty of choppiness with that area of the market, given the Fed meeting coming up next week, of course. The dollar, not much change from yesterday, so nothing really to comment on there. I will tell you that precious metals rotating to the downside. Actually, most commodities, save corn, which is one of the 8 commodity ETFs we show on our market recap page, actually in the green. The rest of them all in the red. Gold and silver both down just over 0.5%. Oil prices going down as well. Cryptocurrencies, a lot of noise actually, and if you look at what's happened with Bitcoin and with Ethereum in the last 24 hours, spiking higher going into the equity open, sort of rolling over going into the equity close. A nice bounce going into the actual equity close, just like we saw with the S&P and the NASDAQ. Bitcoin about 4% above where it was yesterday at the close, and Ethereum up almost 3%. Let's look at a chart of the S&P 500 here briefly and just see where we're at right now relative to where we've been. We're settling into a bit of a range, to be honest with you, and I'm often asked about, first question, like, what do you see in the markets? What's your overall take? And it's often phrased bullish or bearish. And I would remind you that, as our friend Dave Landry would also always tell you, there are three directions to the market, right? You can go up, you can go down, and you can go sideways. Look at where the S&P is now versus where it was about 2 months ago in early January. Look at where the S&P is now versus where it was 4 months ago in early November. Look where it was about 8 months ago. We go back to May of last year. So actually almost 10 months ago. Same exact level. All of those points that I just told you are essentially at the same place we are right now. Now, what's interesting is when you look at the contour of the S&P 500, look at how the shape has evolved. Back here in early February, we're talking about the S&P breaking above 4,100, getting through that resistance area, congestion zone, whatever you want to call it, getting above 4,100, pretty meaningful. And we can see that the S&P got all the way to 4,200. It certainly felt like the August 22 highs around 43.10, 43 and a quarter would have been the next logical step. We stalled out there in early February, quickly came back into this blue shaded area, broke below it, retested inside there about a week and a half ago, and now rotating lower. The other things that we did was break below a trend line using the lows of the last 6 months. So the October closing low, the December, January closing lows lines up pretty well with where we bottomed out at the end of February, and now we've broken through that in the last week. We now have also closed below the 200-day moving average, and today with the bounce off of yesterday's close, we have pushed up intraday basis right up to the 200-day as well. So I would, if I haven't mentioned the word 200-day moving average enough for you yet, I would certainly encourage you to pay attention to it. It's one of those sort of long-term barometers, right? Basic trend analysis. Are we above or below the 200-day moving average? That's a great starting point to any analysis of a chart. And with the S&P, I think that's pretty meaningful. As long as we stay below the 200-day moving average, how constructive is the trend, right? How bullish do you want to be? If and when we start getting back above there, that's where we can get excited. Now, also note that we bounced off of that 3,800 level. That's the green shaded area that you see here. So at this point, I would think of the market as more range bound. On the upside, we have the resistance around 4,000 to 4,100, maybe even more so 4,200, which would be the swing high in February. On the downside, we've just bounced off of support at the December lows around 3,800. As long as 3,800 holds, this isn't too bad, but we break 3,800. I think that immediately brings the October low from last year into play, or at least the June low, which tells us we're getting down in the 3,600s most likely. So key support that we are testing this week, can it hold? Unknown. Now, the way we can try to qualify that or think about what levels, what signals could help us maybe answer that question a little better goes to a number of different things. One would be breadth analysis. The other one would be sector analysis, maybe some asset allocation. Let's touch on each of those briefly if we can. I'll save breadth for a little later in today's show. We're going to do a segment called Banking on Breadth, where we go into a little more detail through some of the indicators like the McClellan oscillator, the Zweig breadth thrust, which may be initiated here this week. And I'll share with you some of the charts that tell the story of breadth and how it's evolved over the last couple weeks. But let's start with the sector rotation. Just think about it. Again, when I like to phrase it in the form of how bearish do you want to be when XYZ, or how bullish do you want to be when ABC is happening? And I would say, how bearish do you want to be when technology still seems to be working, right? The tech sector up 2.25% today. That wasn't the top performer. It was the XLC, Communication Services, which was up 2.8%. Financials, obviously coming off a beaten down level here over the last couple days, up over 2%, followed by consumer discretionary. On the downside, some defensive sectors at the bottom, staples, healthcare, and energy, all up, but up a little less than 1%. Let's look at the chart of the XLK. And again, when you take a step back from your monitor, just look at the trend, right? What is this chart telling you? Overall, constructive or positive or negative, right? Destructive. I would argue the general sense on this chart, from my perspective, is bullish, right? The price is above two upward sloping moving averages. We recently pulled back to the 50-day and bounced off of it today. We're in a pattern of higher highs and higher lows, most recently making a new swing low in early February, now making potentially a higher low around 135, we'll call it, for the XLK, for now holding. Now, you go a level below there and you think of charts like Apple and Microsoft starting to, again, not really showing any negative signs, more sort of bullish to neutral in the last couple months, certainly still holding on. Semiconductors, arguably one of the strongest groups anywhere if you're looking for strength in the equity space. and improving relative strength, strong but not excessive momentum. That's what the chart of the XLK is saying. So when I'm looking for charts that sort of, should cause you to breathe a little easier, thinking that the world is not ending, even though we had a mini financial crisis here, a lot of the market is still holding up okay. I think the XLK is sort of the chart that I have in the back of my mind if I would be making any of those particular comments. Now, before you think that all is great, all is rosy, let's look at some of the other senses or other measures of market sentiment and market health. This is a chart of high yield spreads. We'll spend a moment on this. I bring this chart up occasionally. I feature it every week for my Market Misbehavior Premium members because I think it's a really important way of thinking of non-equity asset classes and how that relates to equity. So there's 3 panels here. At the top, we have what's called the High Yield OAS, which is the High Yield Index Option Adjusted Spread. This is an index from ICE provided by Bank of America. And if everything I just said in terms of high yield and option adjusted spread doesn't make sense, let me clarify for you. High yield bonds are junk bonds. These are bonds of risky companies. These are companies with a non-zero risk of being unable to meet their debt obligations, right? So riskier companies, often smaller, more speculative, emerging growth companies, still issue debt, but they have a very low credit rating, and so they're flagged as high yield bonds or junk bonds. This is the option adjusted spread, which basically just means what sort of spread is there over a treasury bond, a risk-free bond. So how much are high yield bond investors requiring to take on the additional risk of the debt of these risky companies? When high yield spreads are widening, which means it's actually going down on this chart, because I'm plotting it upside down, that is telling you we're in a more risky environment because bond investors are asking for more compensation to take the debt of risky companies. I'm also plotting the VIX upside down. You can see that the volatility overall over the last week has certainly been increasing, coming off a fairly low level of around 18 or 19 for the cycle. When spreads are widening and when volatility is increasing, that tends to line up with the stock market going lower. This is why I plot those first 2 upside down. So the fact that high yield spreads are actually widening is more of a bearish sign for stocks because it tells you that bond investors are sensing that there is a higher and higher probability that these companies will be unable to pay off of their debt. Just to finish up very briefly, and then we're going to take a break, I want to look at Bitcoin, just because I was asked in a lot of interviews about Bitcoin. Of course, a lot of ties with the cryptocurrency space, some of the banks that went under, which is a pretty significant event, of course. When you look at the chart of Bitcoin, I think the 25,000 level is super meaningful. I had a conversation recently with Adrian from Crypto Burb. We were talking about the long-term case for Bitcoin and Ethereum. When I think about the short-term dynamics, though, it's all about where we're at relative to where we've been. Today, we traded up almost to 27,000. As the time we're going live here, we're back below 25,000. That is literally the high from mid-February. If we can close through that level, follow through, that's a pretty strong chart with upside potential. I would argue to 30,000, which would be the high from spring, summer of last year. If we fail to close above 25,000, though, it could mean a mean reversion and maybe going back to some of the short-term lows could be in store. Folks, let's take a quick commercial break. We'll be back banking on breadth, looking at some breadth indicator analysis. We'll see you in a minute. And welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We're so excited to share with you our new StockCharts TV studio. We have a lot of great ideas about how to use this space in the coming months and coming years, and we're excited. It's a pleasure to help inform and educate and inspire you to understand the markets better. A couple quick announcements before we continue on today's show. First, I did want to let you know to contact us, particularly questions that we can use for our Final Bar mailbag. Just send us an email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Check out our StockCharts YouTube channel. Make sure you subscribe while you're there and put a comment below the video you're watching. We'll hope to answer one of your questions live on the air on Friday's show. Upcoming schedule, we have 2 really good guests this week. Tomorrow, on Wednesday, March 15th, we have Ryan Dietrich, who's the Chief Market Strategist at Carson Group. Ryan has worked for years with financial advisors, helping them make sense of the markets with a technically oriented process and a focus on market history. Perfect time to bring Ryan and his insights in front of all of you. And our friend Mish Schneider, frequent guest on StockCharts TV and on the Final Bar, will be joining us Thursday, March 16th. Mish got her start trading agriculture contracts. We'll hear what she thinks about the commodity space and what she thinks is maybe coming next. Let's continue on our show today with our next segment, Banking on Breadth. Let's look at some of the breadth indicators and how they're handling or how they are interpreting this current market environment. I'm going to use my breadth chart list for this. As a reminder, all the charts that I show, almost all of them, are part of my chart pack that all StockCharts members are able to access. If you do want to access these charts, go to your dashboard, go to the bottom of your chart list, and click on a little gray button that says Manage Chart Packs. You will see a chart pack called Dave Keller's Morning Coffee Routine. Install that into your login, and you can get all of these charts and more. We'll start with what I call breadth by cap tiers. Earlier on in my career, I spent a lot of time thinking about index construction. And when you're at a money management firm where you're trying to beat benchmarks, you spend a lot of time going through those benchmarks in detail and thinking about what sector weightings, what types of companies, what factors you're exposed to by going to these different benchmarks, because you're trying to basically figure out how to beat them, right? How can you beat the benchmarks? What tools can you use to take advantage of any structural inconsistencies in the indexes? So I like to think about breadth on different cap tiers, what we call groups of stocks, different universes. I start with a broad universe, which is the New York Stock Exchange common stock only. So it's basically looking at common stocks listed on the New York Stock Exchange. From there, it's large caps, mid caps, and small caps. And I have these very subjectively color-coded: green if I interpret them as generally bullish, red if I interpret them as generally bearish, or what you see right now, neutral, amber. And I toyed with making them more red. I'll tell you what, they're not quite there, but why I think we may be pretty close to it. When I think of breadth, it's all about what it tells you about the direction of the trend, because the cumulative advanced decline lines literally look day to day how many stocks are closing higher or lower, and it keeps a running total of that score. So if the market is going down, it makes sense that the advanced decline lines are probably going down, because there are going to be more stocks going down on the down days than stocks going higher on the up days, is sort of the general logic that you're using there. And it tends to work. Over time, they tend to move in a pretty similar format, which means besides just looking at the S&P and thinking, is it above the moving averages? Is it trending up or down? What trend lines can I draw? You can do the exact same analysis on the cumulative advanced decline lines. Now, if you look, all four of these have broken a trend line. If you take the low from October, you see the higher low in December, you connect those two with a line, you will see we have broken down. Just like the S&P broke down through trend line support here in the last couple weeks, the same exact thing has happened now for all four of these advanced decline lines. You also notice that all four of them are below their 50-day moving average. That's not great. So if I'm bullish, I would much rather see all of these going higher, which is why in late January, early February, it felt like an all clear, long and strong, everything's in good shape sort of signal, which again, I think that's what the charts were telling you at that time. But the real lesson now is look back over the last 4 to 6 weeks and see how quickly this is reversed lower. We've gone from above the moving average to below. We've gone from above trendline support to unable to hold it. I would consider these bearish if we are unable to hold the December low. And I think it's similar to when you think about the structure of the market overall here. As long as we hold the December low, we are arguably forming a higher low and continuing this bullish pattern off the October 22 significant market low. We're unable to hold S&P 3800. We break below there. I think this market all of a sudden looks very negative very quickly. I think it brings the October lows back into play. It would tell me to think of a downside target around 3600 and start to think about the probability of even further downside targets. What about 3,200, if not lower, right? And again, that happens when you are unable to hold support. You have to think about future support levels. So if and when each of these fail to hold their low from December, I would start color coding them red. The reason why I'm mentioning this now is because the S&P's own advanced decline line is there. It's actually testing the December low this week. Will it finish the week above there? I think that's an important question to follow through the course of this week. Now, when you think about stocks and moving averages, what's great is we can take that information and turn it into a breadth indicator. So here we're looking at the S&P 500, the price on the top, and then we're looking at the percent of S&P members above their 200-day, percent above their 50-day. Now, these made a new swing low here going into last weekend, coming out of the weekend. Now here, as we're looking on Tuesday, we can see that we've bounced up just a little bit, but it's still less than 1 in 4 S&P stocks above their 50-day. So just like the S&P has broken right through its 50-day moving average and continued lower, most stocks are actually doing the same thing. Back here in November of last year, 90%, 9 out of 10 S&P names were above their 50-day. Now it's about 24%. So that shows you how many stocks have rotated lower and have broken below their 50-day. If you want to be bullish about the markets, if you want to think about a recovery phase and that the market's just going to rip higher through the Fed meeting next week, I would be looking to see if these indicators can both get back above 50%, especially the top one, which is the percent above their 200-day. The S&P is now testing its 200-day from below. Will it be able to actually push through there? Most stocks, actually over half, 55%, are also below their 200-day moving average. That's not an encouraging sign, again, if you're bullish, but that's the sign you should be looking for. This is an important breadth chart as well. This is the bullish percent index. We're super fortunate to have a series of breadth indicators which we calculate and manage here at StockCharts. It's inspired by the work of Abe Cohen, who worked at a firm called Chartcraft, really popularized point and figure charting for a lot of investors here in North America. And he also created this concept of what are called the bullish percent indexes. The idea is, let's look at a bunch of different point and figure charts. What percent of them are showing a bullish signal as of the most recent buy or sell signal? What percent are most recently giving a buy signal? Right now it's below 30%. You can see I've highlighted this most recent data in green. If you look back, these are the previous times when this indicator has gone below 30%, going back for the last year or so. Look at what's happened basically every time we've seen that. Now, not immediately. This is not saying that the moment it goes below 30% that the market rallies. That's actually not what I'm saying. It's you look for when it actually comes out back above 30%. Just like the RSI, right? A stock becoming oversold, then it bounces out of that oversold region. It's a similar idea to what we're doing here. We're just using a breadth indicator with the same methodology. So I would consider this as an indicator that's been initiated, right? The pattern tells you we're now in a confirmed downtrend. It doesn't tell you when the downtrend is going to be over, but now we have a signal to look for. Look for when this indicator gets back above 30%. That has lined up with some of the more significant recoveries we've seen in the last year. Worth noting that the most recent sell signal was here the first week in February after the indicator went above 70% and rotated lower. That happened at the December peak of last year, the August peak of last year, the April peak of last year, and it also happened in February of this year. This indicator has become one of the more successful ones that I've been following, using breadth to identify the mean reversion and the fact that the market often gets ahead of itself on the upside and the downside. It's currently telling you the market's starting to get a little more extended on the downside. Look to see when we get a buy signal there. Now, we also run bullish percent indexes on other groups. So, for example, here we're looking on the NASDAQ 100. Worth noting, the NASDAQ 100's breadth bullish percent index has not yet initiated. It hasn't gotten below 30%. I would argue this is the NASDAQ 100, which are, sort of the more blue chippy, Microsoft-y, Apple, Alphabet type of stocks. It's not the riskier, higher beta, smaller names that are listed on the NASDAQ. It's more of the blue chip part of the NASDAQ exchange. As a result, it has not quite gotten below 30%. So while the S&P's bullish percent index has sort of begun this process, we haven't gotten that bottoming signal yet from the NASDAQ 100's breadth indicator. Maybe one or two more that we can look at. I did want to mention the Zweig breadth thrust. I mentioned with the bullish percent index, we sort of initiated the indicator, and that's a common technique with technical indicators. You sort of have the leading indicator part of it, right? Something that tells you something is happening, and then you have what's called the confirmation or the trigger, which tells you now that we've set it up, we've sort of set the stage, and now it's go time, right? The trigger has played out. This is an indicator called the Zweig breadth thrust. It's named after a famous market strategist named Marty Zweig. Books that he's written are must-reads. I would strongly encourage you to check out a lot of his market wisdom. I would argue it certainly holds today, even though the market structures are very different. They're sort of timeless groups of investment insights. And one of the techniques that he popularized was the idea of what we now call the Zweig breadth thrust. And it's when the advanced decline data gets to a certain low level. And we actually calculate it using an indicator called !BINYBT. We actually track the indicator that he used to initiate what's called the breadth thrust. What happens is the indicator has to go below 0.4, which it actually did, we'll say about a week ago, right? A couple days ago. From there, we have to actually get a buy signal, which are an initiation, which means we get above 0.4. That's actually happening today. This is the raw data. This is confirmed at the bottom. It's the official index that we calculate after we digest all of the closing data and confirm no issues or anything. We'll give the official reading, but the unofficial reading so far says we've initiated the signal because we got back above 0.4%, or 0.4 that is. What this means is we now have 10 trading days from today. We've got 2 weeks for the indicator to get above 0.63, because what that means, a breadth thrust, is when you have very negative breadth and all of a sudden the breadth starts to improve significantly in a very short time frame. You're starting to see that with certain stocks starting to rally, right? And it's not just the regional banks that got super beaten down like Key that are now bouncing up a little bit. It's other parts of the market, right, that are holding up okay and not really showing the deterioration you might expect if this is a full-blown financial crisis contagion sort of event. So this is another indicator. The bullish percent index is one. The Zweig breadth thrust is now sort of initiated. The question is, we have 2 weeks to get above to a more positive reading. We narrowly missed that back here in January. Almost did it, but it took a little bit too long to do so. If we would do that, I will definitely start shouting on the show and letting you know we have had a valid Zweig breadth thrust. That is one of the more bullish indicators you will find, trying to navigate off of a major market bottom and confirming a new uptrend phase. So a series of breadth indicators, for now, I would say overall negative, but starting to begin those signs that could develop into more of a bullish signal here very soon. Folks, we have to wrap the show and go to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1, our segment banking on breadth. We talk about a series of breadth indicators, and I guess the way I would summarize it is there are different ways to use market breadth. I like to use some of these indicators that have 2 parts, right? An initiation and then a trigger. The initiation tells you we now have the conditions similar to market bottoms or market tops. Then you look for the trigger. What's the confirmation that that low is most likely in? The fact that we should be from a risk on to risk off change, or whatever the indicator is that you're looking at. When I look at the bullish percent index for the S&P 500, I see that we are back down, initiating the beginning of a buy signal. And what we would have to look for is when the bullish percent index gets back above 30. Now, keep in mind, it can be below 30 for days, for weeks, arguably even months, although that's incredibly rare. It could happen. All you're looking for now is when the bullish percent index gets back above 30. I would tell you, this is a great way to use the alert functionality on StockCharts. Enter this ticker, say you want to be alerted when it gets above 30. Let StockCharts do the work for you. It can actually send you a text and let you know when one of those things has actually played out. Here's chart number 2. I want to look at 2 of these stocks that are sort of the names I tend to think of as sort of the NASDAQ 100 names. Now, AMD is an NYSE name. Meta, of course, on the NASDAQ, so it's not exactly that. But when I'm thinking of the NASDAQ's breadth and how strong technology communication services are recently, these are 2 names that overall have pretty constructive setups in any environment. Look at how Meta has rallied off of its new low in November, gapped down in October, continued lower for about a week. From there has rallied higher. The gap higher in early February was key. Then we pulled back to just below 170. This horizontal line represents that low from February. The bottom half of the chart, I'm using AMD, obviously one of the semiconductor names. Similar move where you had a move higher, a gap higher, pulled back, in this case to around 76, and then rotated higher. On my own StockCharts login, I set 2 price alerts earlier today. I said, let me know when Meta gets below 167 and tell me when AMD gets below 76. I don't know when that's going to happen, but I do know I don't have to stare at these charts anymore. As long as they hold those levels, the February low is a higher low, and overall the pattern is fairly constructive. It's another great example. Let the platform actually do some of the work for you. It can watch tens, if not 20s or hundreds of charts for you and alert you when there's something that's actionable. And those are 2 of the levels that I have set alerts for here just today. Finally, airlines taking it pretty heavily here in the last week or so. UAL actually rotated lower 3-4 sessions ago, coming off of a peak around 55. What was concerning about United Airlines, some of the other airlines, is if you look at the high from January to February to March, you can see higher highs in price. You can see the momentum, the RSI is actually sloping downwards, and that's a classic configuration called a bearish momentum divergence. What that means is that the price is going higher, but it's not confirmed by momentum. Upward sloping price, downward sloping momentum. That's usually a warning sign, a red flag of sorts, telling you that the market might be getting ahead of itself. We saw the same thing, by the way, in October, November, and December. We rotated quite a bit lower at that point. We're setting up for that as well here about a week ago. You can see that's now confirmed. We're below the 50-day. Today, we're closing right at that first Fibonacci level. That's another level maybe to watch to see if it can hold. Folks, that's a wrap for the show. So excited to be coming to you live from our new studio here in Redmond, Washington. Lots more great content to come. We look forward to bringing it to you. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.